There is a signal in the financial system that almost no one pays attention to until it's too late. It doesn't appear on breaking news banners. It isn't discussed loudly on social media. And it doesn't move fast enough to feel urgent in the moment. But historically, when this signal appears, it marks the beginning of profound change. That signal is the simultaneous rise of gold and silver. Most people assume that when precious metals rise, it's bullish. They think it means growth, optimism, or speculation. But history tells a very different story. When gold and silver rise together persistently and across economic conditions, it's rarely a sign of prosperity. It's a warning that confidence in the monetary system is quietly eroding. And according to principles long explained by investors like Ray Dalio, monetary systems don't collapse suddenly. They decay gradually, then all at once. What makes this moment especially important is that most people don't understand why gold and silver move together, or what they are actually responding to. To understand that, we need to step back and look at money not as numbers on a screen, but as a system built entirely on trust. Because money itself has no intrinsic value. It only works as long as people believe it will continue to work. Gold and silver exist outside that belief system. They don't depend on governments. They don't depend on central banks. They don't require trust in policy decisions or political stability. They exist as a reference point, one that has quietly tracked the rise and fall of monetary systems for thousands of years. And right now, that reference point is flashing. We are living through a rare moment in American economic history where gold and silver are not just rising, but rising together, persistently, and against a backdrop of record debt, aggressive money creation, and structural imbalances that have never fully been resolved since 2008. To most people, this looks like noise, just another market move. But to those who understand long-term cycles, it looks like something else entirely. It looks like a system under stress. Historically, gold and silver behave differently. Gold is primarily a monetary asset. Silver is both monetary and industrial. Under normal conditions, they diverge. One rises, the other lags. One reflects fear, the other reflects growth. When they rise together, it suggests that the forces driving them are not industrial or speculative, but systemic. This has happened before. In the early 1920s, before Germany's hyperinflation became obvious to the public, gold and silver began rising together. At the time, most people didn't panic. Life seemed normal. Savings were still in banks. Jobs still existed. But the metals were already responding to the reality beneath the surface. Too much debt, too much money creation, and collapsing confidence in the currency. The same pattern appeared in the early 1970s, after the United States ended the dollar's convertibility to gold. The decision itself seemed technical, almost boring, but the market understood something fundamental had changed. Gold and silver surged together, not because of speculation, but because the anchor of the global monetary system had been removed. Those who recognized the signal early protected their purchasing power. Those who didn't watch inflation quietly erase years of savings. The same dynamic emerged after 2008. Central banks responded to crisis with unprecedented monetary expansion. Trillions of dollars were created not through production, but through keystrokes. Gold and silver rose together again, not in a straight line, but persistently, reflecting discomfort with extraordinary policies that had no historical precedent at that scale. What's happening now follows the same logic. This is not about predicting collapse. It's about understanding incentives. Gold and silver don't predict anything, they respond. They respond to imbalances between money and value. They respond to excessive debt. They respond to prolonged negative real interest rates. They respond when trust begins to weaken. Think of gold and silver as the immune system of the financial world. When the system is healthy, they remain quiet. When something is wrong, they activate. And right now, they are activating together. One of the most misunderstood aspects of modern finance is the belief that currencies are permanent. They are not. Every dominant currency in history has followed the same arc: trust, expansion, overuse, and decline. This doesn't happen because of incompetence. It happens because of incentives. Governments are incentivized to spend more than they collect. Politicians are incentivized to delay pain. Central banks are incentivized to stabilize short-term outcomes, even at the cost of long-term distortions. Over time, this creates a system where debt grows faster than productivity, and money grows faster than real value. When that happens, the currency doesn't collapse overnight. It weakens gradually. And gold and silver measure that weakness more honestly than any headline or statistic. This is why focusing only on nominal prices can be misleading. Stocks can rise, real estate can rise, wages can rise. But if everything is rising because the unit of measurement is losing value, real wealth may not be increasing at all. This is why experienced investors don't just ask, "Is my portfolio going up?" They ask, "What is it going up in?" Measured in gold, many portfolios have quietly lost purchasing power over long periods, despite appearing successful on paper. That's not an accident. It's a feature of late-stage monetary cycles. And this brings us to the deeper question most people never ask. Why do gold and silver rise together only when something fundamental is breaking? To answer that, we need to understand three core principles that govern every monetary system, principles that repeat across centuries, cultures, and political systems. In the next part, we'll break down those principles clearly and calmly, without fear or speculation. Because once you understand them, the current moment stops looking random. It starts looking familiar. The three forces behind the signal. To understand why gold and silver rise together during moments of systemic stress, we need to move beyond price charts and into principles. Markets are not driven by opinions. They are driven by incentives, constraints, and human behavior. And throughout history, when monetary systems begin to weaken, the same three forces appear every time, regardless of country, era, or political structure. These forces are not complicated, but they are often ignored. They are money creation, confidence, and the leverage cycle. Together, they explain why gold and silver behave the way they do, and why their current behavior deserves attention. Let's start with the most fundamental principle of all. One, money supply and scarcity. Money is subject to the same laws as everything else, supply and demand. When the supply of something increases faster than demand, its value falls. This is not ideology, it's arithmetic. Modern currencies are created by central banks and governments. They can be expanded almost instantly, at virtually no cost, through credit creation and monetary policy. Gold and silver cannot. Their supply grows slowly, through mining, which requires real capital, energy, labor, and time. Even with technological advances, annual supply growth remains limited. This difference matters more than most people realize. When governments create money faster than the economy produces real goods and services, each unit of currency represents a smaller share of real value. Over time, purchasing power declines. Gold and silver respond not because they are speculative assets, but because they exist outside the system being diluted. Think of it like a balanced scale. On one side, you have paper money, created in large quantities during crises, recessions, wars, and political pressure. On the other side, you have metals whose supply barely changes. As more weight is added to the paper side, the metal side rises, not because it is becoming more valuable in absolute terms, but because the measuring stick is shrinking. This is why gold and silver often rise during periods of aggressive monetary expansion. Not because investors are greedy, because they are responding rationally to dilution. And when both metals rise together, it suggests the pressure is not isolated, it's systemic. 2. Confidence, the invisible foundation of money. Currencies do not function because they are backed by gold or silver anymore. They function because people believe in them. They believe governments will manage them responsibly. They believe institutions will remain stable. They believe tomorrow will look broadly like today. Confidence is not binary, it erodes gradually. And when confidence weakens, people don't panic immediately, they adjust quietly. They reduce exposure to promises. They increase exposure to things that don't rely on trust. Gold and silver are not promises. They are assets without counterparty risk. They do not depend on governments honoring debt. They do not depend on central banks managing inflation perfectly. They do not depend on political stability. That is why they act as confidence barometers. When confidence is high, people prefer productive assets, risk-taking, and leverage. When confidence declines, even subtly, people begin to seek resilience. This shift doesn't show up immediately in consumer behavior or headlines. It shows up first in how capital moves. Historically, this is exactly when gold and silver begin to rise together. Not because people expect collapse, but because they sense fragility. This is a critical distinction. Markets do not wait for disaster to act. They price in risk long before it becomes obvious. As investors like Ray Dalio have often explained, the biggest mistakes occur when people extrapolate recent stability indefinitely into the future. Confidence cycles always turn, slowly at first, then rapidly. Gold and silver are among the earliest indicators of that turn. 3. The leverage cycle. Every economic system runs on leverage. At first, leverage is healthy. Borrowing fuels growth, investment, and innovation. As success builds, borrowing increases. Asset prices rise, confidence grows. Eventually, leverage becomes excessive. Debt grows faster than income. Financial engineering replaces productivity. Short-term gains are prioritized over long-term resilience. At this stage, the system becomes fragile. Small shocks cause large reactions. Liquidity dries up quickly. Promises matter less than access to real value. When deleveraging begins, whether through defaults, inflation, or restructuring, everyone wants liquidity. Not theoretical liquidity. Not paper liquidity. Real liquidity. Gold and silver represent the most historically recognized form of that liquidity. They are no one else's liability. This is why they perform well during late-stage leverage cycles. Not because they produce income, but because they preserve optionality. They allow capital to survive transitions. And when both metals rise together, it suggests the leverage cycle is entering its most unstable phase. This is not speculation. It's pattern recognition. Across centuries, societies that accumulated too much debt eventually faced the same choice: default, restructure, inflate, or devalue. Most choose inflation or devaluation because it is politically easier. Gold and silver respond accordingly. What makes the current moment unique is not that these forces exist, but that they are occurring simultaneously and at scale. Global debt levels are higher than ever. Interest costs are rising. Central banks are constrained. Demographic pressures are increasing. Geopolitical fragmentation is growing. At the same time, monetary tools have already been used aggressively. This limits future flexibility. In past cycles, central banks could lower rates significantly. Today, rates remain constrained by inflation. In past cycles, debt levels were manageable. Today, they are structural. This creates a narrower path forward, and markets sense that. Gold and silver don't need to predict the outcome. They only need to respond to the pressure. And they are responding now. This does not mean collapse is imminent. It does not mean panic is warranted. It means the margin for error is shrinking. And historically, when margins shrink, preparation matters more than prediction. Most people misunderstand gold and silver because they view them through a speculative lens. But their true function is informational. They are signals. Signals that the relationship between money, debt, and trust is changing. Signals that the system is transitioning from one phase to another. And transitions are where risk and opportunity are born. In the next part, we'll bring this understanding into practical terms. We'll look at what this signal means for everyday investors, retirees, and families, and how history suggests people navigate these transitions successfully without fear or guesswork. Because understanding the cycle is not about being early or dramatic. It's about being prepared. By now, one thing should be clear. The simultaneous rise of gold and silver is not about speculation. It is not about chasing returns. And it is not about predicting disaster. It is about preparation during transition. Throughout history, the people who navigated major monetary shifts successfully were not those who predicted exact outcomes. They were those who understood patterns and positioned themselves thoughtfully, without emotion. That distinction matters more than ever today. Because when monetary systems change, they don't affect everyone equally. They reward preparation. They punish complacency. And they quietly reshape what financial security actually means. To understand how this applies to you, let's bring the discussion out of macro theory and into real life. The hidden risk most people miss. Most people think about wealth in nominal terms. How many dollars are in my account? How much did my portfolio grow this year? What does my retirement balance say on paper? But money is only useful for what it can buy. If the unit of measurement is losing value, then growth can be an illusion. This is why experienced investors often measure wealth across long periods not just in dollars, but in real purchasing power. Gold has historically served as that measuring stick. Consider this perspective. Decades ago, a single income could support a family, buy a home, and fund retirement. Today, despite higher wages on paper, many households feel financially stretched. This isn't because people stopped working hard. It's because money itself changed. Gold quietly tracked that change the entire time. When measured in gold, many incomes, savings, and pensions have declined significantly over the last several decades, even as nominal numbers increased. This is the kind of reality that rarely appears in headlines. But it is precisely why gold and silver matter, not as investments, but as references. They reveal what paper numbers hide. Retirement and the illusion of safety. For those approaching or already in retirement, this moment is particularly important. Retirement planning assumes stability. It assumes that savings will maintain purchasing power. It assumes that inflation will remain manageable. It assumes that bonds and stocks will behave as expected. But monetary transitions challenge those assumptions. If inflation remains elevated for extended periods, fixed income assets lose real value. If currencies weaken gradually, purchasing power erodes quietly. A retirement plan that looks solid today can feel inadequate a decade later, not because of poor planning, but because the underlying monetary environment changed. This is not theoretical. History shows that retirees are often the most exposed during inflationary transitions because they rely on accumulated savings rather than future earning power. Understanding this does not mean abandoning traditional assets. It means recognizing concentration risk. When everything you own is tied to a single currency system, you are vulnerable to changes in that system. This is why diversification across asset types and across forms of value has historically been a form of resilience. Gold and silver as insurance, not speculation. One of the biggest mistakes people make is viewing gold and silver as vehicles for fast profits. That mindset leads to poor timing and emotional decisions. Historically, their most important role has been wealth preservation, not wealth acceleration. A modest allocation, often discussed in the range of single-digit percentages, has served as insurance against monetary instability, not as a replacement for productive assets. This framing matters. Insurance is not purchased because you expect disaster tomorrow. It's purchased because you understand uncertainty exists. Gold and silver serve a similar function in long-term planning. They are not designed to outperform everything else at all times. They are designed to preserve purchasing power when other things struggle. That distinction separates thoughtful strategy from speculation. Liquidity and optionality. Another overlooked lesson from past transitions is the importance of liquidity. During periods of monetary stress, opportunities emerge, but only for those who can act. When asset prices fall suddenly, those who are over-leveraged are forced to sell. Those with liquidity can buy. Gold and silver, historically, have provided a form of liquidity that is not dependent on the financial system functioning perfectly. They allow flexibility. They allow patience. And most importantly, they allow optionality during moments when others have none. This is why they often perform well during late-cycle environments, not because they generate income, but because they preserve freedom of choice. The role of skills and adaptability. It's also important to recognize that financial assets are only one part of resilience. Throughout history, the most durable form of wealth has been human capital. Skills, knowledge, adaptability. These cannot be devalued by inflation. They cannot be printed away. They cannot be frozen or diluted. People who invest in understanding systems, cycles, and decision-making consistently navigate change better than those who rely solely on static plans. This is a core principle emphasized by long-term thinkers like Ray Dalio. Cycles change, but principles endure. Watching the right signals. Rather than trying to predict exact outcomes, history suggests focusing on indicators. Pay attention to the pace of money creation. Monitor real interest rates. Watch debt relative to economic growth. Observe global demand for currencies. When these indicators move in certain directions simultaneously, transitions tend to follow. Gold and silver often reflect these shifts before they are widely discussed. That does not make them magical. It makes them honest. They respond to math, incentives, and behavior, not narratives. A long-term perspective. Over the last 500 years, the global monetary system has changed several times. Each transition felt permanent while it lasted. Each seemed unthinkable to change until it did. These shifts did not happen overnight. They unfolded over decades, with moments of acceleration. The United States still possesses enormous strengths: innovation, capital markets, institutions, and human talent. But it also faces structural challenges that history suggests cannot be ignored indefinitely. Understanding this is not pessimism. It is realism. Preparation, not panic. The most important takeaway is this: the rise of gold and silver together is not a call to fear. It is a call to awareness. It suggests that the current system is under strain, and that long-term thinking matters more than short-term noise. History consistently shows that those who prepare during periods of apparent calm navigate transitions with far less stress. They don't rush. They don't speculate. They don't panic. They diversify thoughtfully. They preserve flexibility. They focus on principles rather than predictions. Gold and silver have survived every monetary system in history, not because they are perfect, but because they are independent. Their current signal deserves attention, not because it guarantees an outcome, but because it reveals a process already underway. In the end, real wealth is not about predicting the future perfectly. It's about understanding cycles, respecting risk, and positioning yourself so that no single outcome can derail your life. That has always been the lesson. The question is not whether change is coming. The question is whether you will be prepared when it does. Backhand index pointing right. What do you think gold and silver are really signaling about the future of money? If this perspective helped you see the cycle more clearly, subscribe to Next Gen Wealth for calm, principle-based insights that help you prepare, not panic.